Here is the full script. Just word, single weekday. At 8 in the morning, a number appears on screens across the United Kingdom. That number goes up, or it goes down. And then millions of people, on the radio, on television, in newspapers, on their phones, repeat that number as if it explains something important about the world. The FTSE 100 was up 47 points today. Markets fell sharply as investors reacted to. The index closed at a record high. You have heard these sentences hundreds of times, but here is the question almost nobody asks. Why did it move? Not what the headlines say, not the surface explanation. The real reason, the deep, structural, sometimes uncomfortable reason that this single number shifts by hundreds of points in a single session and then shifts right back the next day and then does it again and again for decades without ever stopping. That is what this video is about. Because once you understand why the FTSE 100 actually moves, not the story they tell you, but the genuine mechanics underneath, you will never look at financial news the same way again. You will start to see patterns. You will start to ask better questions, and you will stop being confused, frustrated, or misled by the noise. I am going to take you through this step by step. We are going to start at the very beginning, what the FTSE 100 actually is, because most people have a fuzzy understanding of that. Then we are going to go deeper than most explanations ever go, into the real forces that move it every day. We are going to talk about human psychology, institutional behavior, global capital flows, interest rates, currency markets, sentiment, algorithms, and the strange feedback loops that make financial markets behave the way they do. No jargon that I do not explain. No assumptions about what you already know. This is designed to be understood by a complete beginner and to be genuinely useful to someone who has been watching markets for years. By the end of this video, you will understand something that most casual observers of financial news never figure out. And that is worth 70 minutes of your time. Let us start at the beginning. The FTSE 100 is an index. That word, index, is worth pausing on because it sounds technical, but it describes something very simple. An index is a list. In this case, it is a list of 100 companies. Specifically, the 100 largest companies listed on the London Stock Exchange, measured by something called market capitalization. Market capitalization simply means the total value of all the shares a company has issued. You multiply the number of shares by the current price of each share, and that gives you the market cap. So if a company has 1 billion shares, and each share costs £5, the market cap is £5 billion. The FTSE 100 takes the 100 companies with the biggest market caps on the London Stock Exchange and puts them together into a single number. That number goes up when the prices of those shares go up, on average. It goes down when the prices fall. But here is something important that most people do not realize. The FTSE 100 is not an equal average. It is what is called a weighted index. That means bigger companies have more influence over the number than smaller ones. Right now, a handful of enormous companies, oil giants, pharmaceutical firms, large banks, mining companies, together account for a significant portion of the entire index's movement. If one of those very large companies rises 5% in a single day, it can move the whole index by more than all the small companies moving in the opposite direction. So when you hear that the FTSE 100 is up, what is really happening is that a weighted combination of share prices across 100 companies has increased, and the biggest companies in that index have the loudest voice. This matters for everything we are going to talk about. Now, the FTSE 100 was created in January 1984. It started at a base level of 1,000. Everything it has done since, every rise, every crash, every recovery, is measured against that original starting point. When you hear that the FTSE is at 8,000, that means it is 8 times higher than it was 40 years ago. In aggregate terms, accounting for the changing composition of the index over time. The index is reviewed every 3 months. Companies that have grown large enough move in. Companies that have shrunk below the threshold move out into the FTSE 250, which is the next tier down. This review process itself causes price movements, which we will come back to. But the most important thing to understand right now is this. The FTSE 100 is not the British economy. This sounds obvious when you say it out loud, but the confusion between the two is one of the most persistent misunderstandings in financial commentary. Here is why they are different. First, most of the companies in the FTSE 100 earn the majority of their revenue outside the United Kingdom. Companies like Shell, HSBC, BP, Unilever, AstraZeneca, Rio Tinto, these are global businesses. Their profits come from America, Asia, Africa, Australia, and dozens of other markets. So when the British economy has a bad year, these companies may actually do fine, because their fortunes are tied to the global economy more than the domestic one. Second, the FTSE 100 does not include privately owned businesses, which are enormous in the UK economy. It does not include the NHS, which is one of the largest employers in the world. It does not include most small businesses, which employ the majority of UK workers. The FTSE 100 is a window into one specific layer of the economy: large, publicly listed, internationally exposed companies. Third, and this is subtle, the FTSE 100 is priced in pounds sterling. So even if every company in the index did nothing, earned exactly the same profits, had exactly the same business, the index number would still move if the pound changed value against other currencies. A weaker pound makes foreign earnings worth more in sterling terms, and that can actually push the index up even when the underlying businesses have not changed at all. So already, before we get into the real forces that move the index, we have uncovered something important. The FTSE 100 is measuring something more complex and more global than most people think. It is not a thermometer for the British High Street. It is a weighted, international, currency-sensitive snapshot of 100 large companies, updated in real time throughout every trading day. With that foundation in place, let us now get to the real heart of this video. Why does it move? Every single day. At its most basic level, the answer is simple. The FTSE 100 moves because share prices change. And share prices change because people are buying and selling shares at different prices throughout the day. Every time someone buys a share, they agree to pay a price. Every time someone sells, they agree to accept a price. The most recent transaction price becomes the current market price. When more people want to buy than sell, prices get bid up. When more people want to sell than buy, prices get pushed down. The FTSE 100 aggregates this process across 100 companies and thousands, sometimes millions, of transactions per day and turns it into a single number. But that just pushes the question back one level. Why are people buying and selling at different prices than yesterday? What changes between one day and the next to make all these transactions happen at different levels? This is where it gets genuinely interesting, because the answer is not just the news. The answer involves layers of human behavior, institutional mechanics, global systems, and sometimes pure randomness, all interacting simultaneously. Let us work through them one by one. The first and most important thing to understand is that a share price is not a measure of what a company is worth right now. It is a measure of what people collectively believe that company will be worth in the future. Specifically, what its future earnings will be, discounted back to a present value. This is a profound point. When you buy a share, you are not buying a piece of today's profits. You are buying a claim on all the future profits the company will ever generate. So the price of a share is really a bet, a collective, continuously updated bet about the future. And the future changes constantly. New information arrives every minute. Economic data gets released. Companies publish earnings. Politicians make decisions. Weather events affect supply chains. Foreign governments change policy. A competitor launches a new product. A scientist publishes a study. All of this information is relevant to estimating future earnings. And as information changes, bets change and therefore prices change. This is why the FTSE 100 never stops moving. The world never stops producing new information. And as long as new information keeps arriving, the collective estimation of future value keeps...
This is why the FTSE never stop moving. The world never stop producing new information. And as long as new information keeps arriving, the collective estimation of future value keeps shifting. But at this crucial, the market does not respond to reality directly. It responds to how reality compares to what they expected. This distinction changes everything. If a company announces that its profit loss by 10% by 10%. That sounds like a good news. But if investors had expected 20%, the share price will fall, but not because the company did badly in absolute sense, but because it did worse than expected. The expectation was already back in the price. The new information is the gap between expectation and reality. This is why you sometimes see the FTSE 100 fall on good news and rise on bad news. What matters is not whether the news is good, bad, or in isolation. What matters is whether it is better or worse than what the market had already priced it in. Once you understand this, a lot of confusing market behavior starts to make sense. Of all the forces that move the FTSE 100 on daily basis, interest rates are arguably the most powerful and the most misunderstood. Let's put this up. First principle. Imagine you have £10,000 to invest. You have two choices. You can put in completely safe government saving bonds that pay you 3% per year with zero risk of losing your money. Or you can invest in shares with might go up or down care really risk. If the safe option pay 3%, you are only going to take the risk of share if you think they will return considerably more than 3%. Enough more to compensate for the risk. This is extra return for taking risk is called the equity risk premium. Now, imagine interest rate rise. The safe government bond now pay 5%. Suddenly, shares look less attractive by comparison. You need to believe the market will return much more than 5% to justify the additional risk. As a result, investors tend to shift money out of shares and into bonds. Demand for share fall, price fall. The FTSE 400 fall. The reserve is also true. When interest rates fall, self-saving account and bond pay very little. 1% return on saving an account is barely worth considering. So, investors move money into shares searching for better returns. Demand for share rises. Prices rise. The FTSE 100 tend to rise. This is why every single Bank of England interest rate decision and every high about what the Bank of England might do in the future move the FTSE 100 sometimes dramatically. But it goes deeper than just competing with bonds. Interest rates also affect the actual businesses inside FTSE 100 directly. Think about a company that wants to expand, open new factory, hire more staff, build new infrastructure. To do that, it often borrows money when interest rates are low. Borrowing is cheap. Expansion is affordable. Profits are easy to grow. When rates are high, borrowing becomes expensive. Expansion slows. In some cases, companies that borrowed heavily at low rates started to struggle with repayment when rates rise. So high interest rates compress profit, which reduce future earnings expectation, which reduce share prices. And low interest rates can surcharge growth, increasing earnings expectation and pushing prices higher. There is a third channel too. Interest rates affect the spending power of ordinary consumers and businesses. So there is a third channel too. Interest rates affect the spending power of ordinary consumers and businesses. When mortgage rates rise, homeowners less money to spend on the things. Consumer-facing business in the FTSE 100, retairs, hospitality company, leisure business see low demands. Their revenue fall, their share price fall. All of this means that when the Bank of England raises or cut later, the FTSE 100 does not just respond because of the bond comparison. It responds because the change applies through every part of the economy and every business model inside of index. And critically, as we establish it, every market move on, expectation not just events. So the FTSE 100 start moving long before the Bank of England actually change rate. It moves when investors update their belief about what the bank will do. A speech by the governor, a piece of inflation data, an employment report. There's all shifty expectation about future rate decision, and that shifty prices today. There is a concept called forward guidance that central banks use, communicating their intention in advance to manage this expectation. When the Bank of England signaled that it planned to raise rates, market adjust immediately. Even when before any actual rate change, in very real sense, the signal moved the market just as much as the action itself. This creates a strange loop. The Bank of England watches market to understand how its communications are being interpreted. Market watch the Bank of England to anticipate its next move. Each influence on the other in continuous feedback cycle. During the period from 2021 to 2023, when inflation surged across the Western world and central banks began raising rates sharply after a year of near zero rates, the FTSE 100 and market global whispered dramatically as investors constantly reversed their expectation about how rate would go and how long they would stay there. Understand this mechanism explains almost all of the volatility. We touched on currency earlier, but it deserves its own dedicated focus because it's one of the most misunderstood dynamics in UK financial markets. The FTSE 100 has a distinctive and somewhat counterintuitive relationship with the British pound. In most countries, a strong domestic currency is seen as positive for the stock market because it reflects confidence in economy. In the UK, the opposite is often true. Here is why. As we establish the majority of revenue earned by FTSE 100 companies come from outside the UK. When those companies earn dollars, euro, or yen abroad, they eventually convert those earnings back into pounds for their accounts. If the pound is weak, those foreign earnings convert into more pounds. The company looks more profitable in sterling terms, its share price tends to rise. If the pound shrinks, those same foreign earnings convert into few pounds. The company's reported profit in sterling fall, its share price tends to fall. This is why even that weakened the pound, a period of political uncertainty, a surprise Bank of England decision, a poor economic data release can actually cause the FTSE 100 to rise. And even that strength the pound can cause the index to fall. This is spread out of striking fashion during the Brexit referendum in June 2016. When the result came in that the UK had voted to leave the European Union, the pound fell sharply, at one point falling its lowest level in decades. Many people expected the stock market to collapse. Instead of the FTSE 100 actually rose over the following day. The weak pound was making all these foreign earnings more valuable in sterling terms. This does not mean Brexit was good for the UK economy. It means the FTSE 100 is measuring some different from the health of domestic economy. The index actually did well partly because of very thing that was causing economic damage. This is a powerful illustration of why conflicting of FTSE 100 with the state of Britain is a such fundamental error. Currency movements happen constantly and for many reasons. The US Federal Reserve decision affected the dollar, which affected the pound-dollar exchange rate, which affect FTSE 100 company earnings, which affect in the index. The European Central Bank's decision affected the euro, which flows through in similar ways. Global demand for safe haven currency, geopolitical uncertainty, commodity prices, trade balance data. All of these move currency, and currency movement feed directly into FTSE 100 variation. The FTSE 100 does not exist in isolation. It is one of nodes in a global network of financial markets that are all continually influencing each other. Let us trace how a single event on the other side of the world can move on the FTSE 100 in London. The US stock market, specifically the S&P 500 index, is by far the largest and most influential equity market in the world. American market closed in evening UK time overnight. Future market continue trading. These are contracts that be on when market will open tomorrow. When UK traders arrive at their desk at 7 or 8 in the morning, one of the first things they look is how American futures are positioned and how Asian markets have traded overnight. If Wall Street had a bad night, if American futures are down 2% when UK market open, the FTSE 100 will almost certainly open low. not because anything specifically British has changed, but because globally investor sentiment has shifted, and the UK market are part of that global system. Why does America sentiment affect the UK markets? Several reasons. First, many large institutional investors, pension funds, sovereign wealth fund, hedge funds, operated globally and manage portfolios across multiple markets simultaneously. If they decide to reduce risk exponentially, they sell across all the market as include UK equity. Second, many FTSE 100 companies have significant US operations and the US investors. American market movement affect their valuation directly. Third, sentiment is contagious. When the world's largest market is pressured, that fear spread to other markets. When it is confidence, that confidence spread this is not irrational. If American consumers stop spending, that eventually affect global trade, which affect the company everywhere. This is global interconnection also learned through commodity markets. Oil is one of the most important commodity for FTSE 100 because UK index has a large weight in energy company. Particularly Shell and BIP, these are two of the largest companies in indexed by market capitalization. When the oil price rises, their revenue rise, their project profit rise, and their share prices rise, pulling the world index with them. When oil falls, the reserve happens. Oil prices themselves are driven by global supply and demand decisions made by OPEC countries. Geopolitical tension in the Middle East, Chinese economic activity, American share production, and seasonal factors. All of these feed through in share and the BP's share prices and therefore in FTSE 100 itself. Mining company Rio Tinto, Anglo-American, Glencore are also large FTSE 100 components. Their fortunes depend on commodity prices, copper, iron ore, gold, aluminum. These are heavily influenced by China's industrial activity. When China's economy is growing strongly, it consumes enormous quantity of metal and raw materials. Demand lies, prices rise, mining company profit lies. The FTSE 100 rise when China slows the reserve, so as slowdown in Chinese manufacturing communicated through as unofficial purchasing managers index report published in Beijing at 3 in the morning UK time can move the FTSE 100 by lunchtime in London. This is how connected these markets are. Pharmaceutical company AstraZeneca, Giska are another major FTSE 100 sector. Their valuations are affected by drug approval decisions from regulators in America and Europe, by clinical trial results, by patent expiration, and by pricing pressure from governors. A single regulator decision on drug application can move AstraZeneca share price by 10% in a day, which is large enough to affect the entire FTSE 100. The point is that FTSE 100 is simultaneously tracking oil market, copper market, pharmaceutical regulation, China's industrial demand, American consumer confidence, European trade policy, and dozens of other global forces. All at once all day long every day, here's something that financial textbook often understate. A huge proportion of daily FTSE 100 movement has nothing to do with fundamental change in business value. It is driven by human psychology, by fear, by greed, by herd behavior, by story, and by narrative, by mood. This is not a cynical view. It is a well documented and extensively studied theory of how markets work. Let us start with fear and greed, the two most powerful emotions in markets. When things are going well, when the economy is growing, profits are rising, unemployment is low, and confidence is high, investors become more willing to take risks. They buy shares. They accept low potential return in exchange for being in markets. Prices rise sometimes beyond what the underlying fundamental justify. This is what people call a bull market. When sometimes going wrong, a financial crisis, a pandemic, a war, a surprise political event, investors become afraid. They want to reduce risk. They sell shares and move into things they perceive as safe governments. Bonds, gold crash, price fall, sometimes far beyond what the underlying damage to businesses actually justifies. This is a bear market. Both extremes are driven as much by emotion as by calculation. And this is emotionary amplification is one of the main reasons markets move more violently than the actual underlying change in business value would suggest. Behaviorally, economists have documented many specific psychological patterns that affect markets. Loss aversion means that people feel the pain of loss largely twice as intensely as they feel the pressure of an equivalent gain. This is cause an investor to panic sell when market fall, accelerating the decline. It also causes people to hold on losing investment far too long, hoping to avoid the psychological pain of crediting a loss. Herding behavior means that investors tend to follow what others are doing, especially in uncertain conditions. If a large number of investors start selling, others see the falling price, assume those sellers know something they do not, and also sell. This creates cascading sell-off that can push market downfall faster than any fundamental analysis would suggest. Recency bias means that investors give too much weight to what has happened recently. After a long period of rising, market people become overconfident and take too much risk After a sharp fall, they become over thoughtful and may hard to return. Both patterns amplify the movement that they already happening. Anchoring is the tendency to fix on specific number as reference point. If FTSE 100 was at 8,000 and fall to 7,000, people anchor on 8,000 and see the current level as a bargain which can trigger buying. Or buy anchor on recent high and treat any fall as armoring, triggering, selling. These anchor are psychologically powerful but often economically arbitrary. Confirmation bias causes investors to seek out information that support what they already believe and to dismiss or downplay information that contradicts it. An investor who is bullish on the market will focus on positive data and find reason to discount bad news. A bearish investor will do the opposite. This polarization can cause a group of investors to be systematically wrong for extended periods. Narratives are perhaps the most underappreciated driver of market movement. Investors do not just respond to data, they respond to story. A compelling story about why a sector is the future can drive valuation far beyond what the current number justifies. The dot-com bubble of the later in 1990 was largely a narrative phenomenon. A story about the internet transforming everything. And when the narrative lost credibility, price collapsed. More recently, stories about artificial intelligence have driven enormous movement in technology stock globally. The story may well be true in the long run, but the speed and scale of the market response is as much about the power of the narrative as about measurable near-term earnings. The FTSE 100 is influenced by these narrative forces too, even though it is had as a different character to the more technology-heavy American indices. A story about a commodity super cycle, or about the energy transaction, or about UK political stability can shift sentiment toward or away from the index and drive weeks or months of directionary movement. Market sentiment is now tracked in real time through various measures. There is an index often called the fear index that measures expected volatility in American market, and it closely watched globally. When it shifts, it signals fear and usually corresponds to market force. When it low, it signals complacency, which sometimes preceded sharp correction. All of this means that any given day, the FTSE 100 movement is some miniature uh, rational response to new information about future earnings and emotional response to that same information amplified through human psychology. Separating the two is genuine difficulty even for professional investors. One of the biggest uh, misconceptions about the financial market is who is actually doing the trading. Many people imagine it millions of individuals making individual decisions. In reality, the vast majority of trading volume is driven by large institutions, and increasingly by computer running automated strategies. Let us look at institutions first. The biggest player in UK equity market are pension funds. British pension funds and collectively manage hundreds of billions of pounds are significant owners of FTSE 100 shares. But they do not trade consistently. They rebalance periodically, adjusting their portfolios to maintain target weightings. When pension funds rebalance, buying or selling large blocks of shares, they move market simple by the scale of what they are doing. Insurance companies hold a large equity portfolios for similar reasons. Sovereign wealth funds from countries like Norway, Singapore, and the Gulf states have massive UK equity holdings. Investment bank manage proprietary trading book, mutual fund, and exchange traded fund manager money on behalf of millions of individual investors. All of these entities have different mandates, different time horizon, different risk tolerance, and different triggers for buying and selling. Their interaction creates the complex, sometimes chaotic pattern of daily market movement. One particularly important institutional mechanic is index rebalancing. As we mentioned, the FTSE 100 is reviewed quarterly and company move in and out. When a company is promoted into the index, all the funds that track the FTSE 100 called passive fund or index trackers must buy that company shares. They have no choice. The mandate requires them to hold exactly the index composition. The scale of passive investment is now enormous. Hundreds of billions of pounds are invested in F800 tracked funds. So, when rebalancing happens, the buying and selling pressure is massive and predictable. Professional traders front-load this rebalancing, buy the shares that are about to be added to the index in advance, knowing that tracker fund will have to buy them and selling one that buying pressure arrives. This is a clear example of market movement that has nothing to do with any change in business fundamentals. It is driven entirely by the mechanics of how the index is constituted and how passive investing works. Now let us talk about algorithms. Today, a substantial share of trading activity in equity market is conducted by algorithm system. A computer program that executes trades automatically based on predefined neural or machine learning models. This algorithm operates on timescales ranging from milliseconds to days. At the front end, high-frequency trading firms use algorithms that can execute thousands of trades per second, exploiting tiny price difference across different exchanges or different instruments. They profit from fraction of penny per share at enormous scale and enormous speed. Their activity provides liquidity to markets. There is almost always a buyer or a seller available, but it also introduces its own partners and sometimes its own volatility. At slow speed, quantitative found learn algorithm strategy that look for partner in price data, in economic data, in sentiment data, and in other information resources. When this partner signal a buy or a sell, the system executes automatically. When many quantitative found identify the same signal at the same time, as they sometimes do, because they are all looking at the similar data, they can all move in the same direction simultaneously, creating sharp price movement in very short time frames. This is one reason why markets sometimes seem to move very quickly without an obvious news trigger. The trigger exists, but it is a quantitative signal that many algorithms identified simultaneously, and the resulting flood of orders all going the same way move prices rapidly. The machine learning systems are now also being deployed that analyze news, article, social media, earnings call, transcript, and other text sources to gauge sentiment and make trading decisions. These systems are reading and reacting to information faster than any human can. They are part of why marketing reaction to news even happens so quickly. Sometimes the price has already moved significantly before many human traders have even finished reading the headline. Understanding that much of the daily movement in the FTSE 100 is being driven by machine following ladders than rather than human making constantly judgment change how you think about it. The market is not always processing information the way of rational economics would process it. It is learning many different programs simultaneously, and the interaction of those programs create the partner you see. Every week, bring a short load of economics data release, and this release are major drive of FTSE 100 movement. The most important category are inflation data, employment data, economic growth data, and business surveys. Inflation data, typically published monthly, tells market how quickly prices are rising across the economy. In the UK, the key measure in the Consumer Prices Index. When inflation comes in higher than expected, markets worry that the Bank of England will have to raise interest rates to bring it down. As we established, higher rates are generally bad for equities, so a high inflation reading tends to push the FTSE 100 lower. A lower than expected inflation reading can push it high by suggesting later might fall or stay on hold. Employment data tells market how healthy the labor market is. Strong employment is a double-edged signal. It suggests a healthy economy, which is good for consumer-facing businesses. But full employment can also drive wage growth, which can fuel inflation, which can push later high. Market weigh these competing implications and move accordingly. GDP data, measuring the overall size and growth of the economy, is released quarterly in headline form and more regular in monthly estimated. A surprise contraction or even a weaker than expected expansion can move the FTSE 100 because it affects expectation for corporate revenue growth. Business surveys are leading indicators. They ask business how they are feeling about the near future rather than measuring what has already happened. The Purchasing Manager Index is one of the most closely watched surveying business in the manufacturing and services. A reading above 50 signal expansion, below 50 signal contraction. These come out monthly and often cause immediate market reaction. Each of these data releases creates a moment where reality is compared to expectation. The economists and analysts survey before each release form a consensus estimate. If the actual number beats that consensus, market typically react positively. It misses, market typically react negatively. The size of surprise determines the size of market movement. American economic data is also extremely important for the FTSE 100 because the US economy is large and so interconnected with the rest of the world. The US job report, released on the first Friday of each month, is arguably the single most anticipated piece of economic data in global financial markets. It routinely moves the FTSE 100 as well as American indices. Some of the sharpest FTSE 100 moves in history have been caused by events that nobody expected and no model predicted. These are sometimes called black swan events, a term used to describe rare, high impact occurrences that are obvious in hindsight but essentially unforeseeable in advance. The COVID-19 pandemic in February and March 2020 caused one of the fastest and steepest market fall in history. The FTSE 100 fell by more than a third in the space of weeks as the scale of the crisis became clear. Then, over the following 18 months, it recovered most of those losses driven by massive government stimulus, vaccine development, and the eventual reopening of economies. The financial crisis of 2080, 2080 and 2009, triggered by collapse of the American housing market and the near failure of major global banks caused the FTSE 100 to fall the near halt from its peak. It took years to recover. Wars and geopolitical crises affected the market through several channels. They disrupted supply chain, particularly for energy and food. They create uncertainty and market price uncertainty negative. They sometimes trigger sanctions and trade disruption that affect a multinational company directly. The Russian invasion of Ukraine in February 2022 caused immediate sharp movement in Europe market, including FTSE 100. Energy prices skipped, grain prices surged, defense stock rose sharply, company with Russian exposure fell. The combination of supply chain disruption and surging energy prices contributed to the inflationary wave that then drove central banks to raise the rate, which in turn drove further market volatility through 2022. Election and political events are another source of periodic volatility. The UK general election, the American presidential election, Italian election, French election, any major democratic event in a significant economy has the potential to move market if the outcome affects expectation about economy policy. Political surprises are particularly powerful. The Brexit vote in 2016 caused extraordinary volatility across UK assets. The real reason the FTSE 100 moves every day in that world is complex and interconnected, and markets are the world's most liquid and continuous attempt to put a number on that complexity in real time. It is imperfect, it is noisy, it is sometimes irrational, but it also one of the most fascinating and leveraging systems that human society has created, and really understanding it, is worth the effort. Thank you for spending this time with me. If this was useful, please share it with someone who has ever been confused or misled by financial news. And if you want to go deeper of, on any of the topic we covered today, interest rate, currency market, behavioral finance, long-term investing, there is a lot of more to explore. Take care of yourself and keep asking the real question. Thank you, bye bye. See you to the next video.